Welcome back to Smart Stock Sam. There's big news on this stock recently, and market is reacting as expected. But let's slow down and focus on the facts and see how they are shaping the narrative. I'll cover what's real, what's noise, and what it could mean next. For quick updates like this, subscribe and tap the bell to catch every market move on time. All right, here we go. How does a company deliver more cars than ever before, hit a historic million vehicle milestone, and sign a massive deal with the world's largest battery maker, only to see its stock price tank to a 5-month low? Today, we are breaking down the absolute paradox of NIO stock. But before we get into the charts, we have to ask the questions that Wall Street is currently scrambling to answer. Why is a record-breaking year being treated like a total failure by the big banks? What did the CEO just reveal over the last 48 hours that completely changed the roadmap for 2026? And is the secret weapon behind their global energy grid finally ready to pay off for shareholders? To understand where we are going, we have to look at the massive achievements that, strangely, weren't enough to satisfy the bears. If you look at the headlines, NIO should be soaring. On January 6th, the company officially rolled its 1 millionth car off the line in Hefei. For a startup that many predicted would go bankrupt 4 years ago, this is a monumental achievement. Not only that, but they just closed out 2025 with their best delivery numbers in history. Over 326,000 vehicles handed over to customers. But here is the catch, and the reason why the stock is currently struggling near the $4.60 mark. Wall Street is a numbers game, and while those 326,000 cars represent a record, it was only 73% of the ambitious target NIO set for itself at the start of the year. This miss has given the bears a reason to ignore the growth and focus strictly on the cash burn. However, if you're only looking at the delivery numbers, you're missing the real story. The most important news for NIO investors didn't come from the factory floor, it came from a boardroom meeting with CATL. NIO and the world's biggest battery manufacturer just signed a 5-year strategic alliance. This isn't just about buying batteries, it's about standardizing NIO's battery swap technology. NIO and CATL are building an open, scalable ecosystem. Think about that for a second. If battery swapping becomes the industry standard in China and beyond, NIO goes from being just a car manufacturer to being the energy grid for the entire EV industry. That is the trillion-dollar bet that most retail investors are ignoring right now. But even that CATL deal is being overshadowed by what has surfaced in the last 72 hours. Over the weekend, reports began circulating that NIO Power, the subsidiary responsible for the battery swap stations, is seeing a massive surge in usage from non-NIO brands. This is the first concrete evidence that their standardization strategy is actually working. Furthermore, in a tech summit, CEO William Li hinted that the company is fast-tracking its timeline to achieve cash flow break even by the third quarter of 2026. This shift from pure growth to fiscal sustainability is exactly what institutional investors have been waiting to hear. Yet the market hasn't fully priced in this move toward profitability. While the energy infrastructure matures, the global expansion isn't stopping. NIO just confirmed they are heading to Australia and New Zealand in the second half of 2026. They aren't just sending their high-end luxury SUVs either. They are leading with their new sub-brand, Firefly. These are small, high-tech, affordable EVs designed to fight for market share in regions where Tesla is currently the only big player. By launching a more affordable brand, NIO is finally addressing the criticism that their cars are too expensive for the mass market, potentially opening the door to a much larger demographic of buyers. So, why is the stock down nearly 10% this month despite all this progress? Technically, we are in a massive tug of war. We saw a classic sell the news event after the CATL announcement, with the price dropping from nearly $6 down to the mid-4s. Right now, NIO is testing a critical support level. If the 40-60 floor holds, we are looking at a classic double-bottom setup that could launch the stock back toward the $6.30 resistance level. The sentiment on Wall Street remains split. You have analysts at the Maxim Group and 24/7 Wall Street calling for a recovery towards $7, while others fear the ongoing price war in China will continue to eat into margins. But here is the reality. NIO is now a million-car company. They have 3 distinct brands, NIO, Onvo, and Firefly, and they have the backing of the world's largest battery producer. Is NIO a risky play? Absolutely. But at under $5 a share, you're buying a company that has survived the worst of the EV winter and is now entering a massive product cycle. Keep your eyes on that support level, watch the institutional reporting coming next, and volume fluctuations. And remember that in the EV race, it's not just about who builds the car, it's about who owns the infrastructure. Stay cautious, keep your eyes on the data, and limit your position size until clear breakout signal is confirmed through price action. Alright, that's the update. If you want more quick fact-based insight like this, subscribe and tap the bell icon so you don't miss the next one. Drop your thoughts in the comments, and I'll see you in the next update on Smart Stock Sam.